Guys, let's suppose you are trading Euro USD. You see the market, you draw a trend line from here. You see the market is respecting the trend line, and bump the market again comes to this area. You see here is a trend line. The trend line will give support here. The market also gives a little reaction from here, gives this little reaction. Inside you, FOMO, fear of missing out, is created. You see this little reaction and think the market will move, thinking you'll be left behind, your trade will be missed, the move will be missed by you, blah, blah. This is called fear of missing out. You get this fear here. Quickly, you create your long entry here, you make a long entry like this, and keep your SL stop loss on the breakout of the trend line. What does the market do? The market gives you a little reaction, then boom, your stop loss. Now, what happened to you here? This is called inducement. It's like a trick that forces traders to enter early. Basically, inducement is used in the market for SL hunting. Big players first create inducement, bring early entries from traders, then take out their SL and later bring in their big move. Meaning, you see here, the market came above the trend line, the market gave a little reaction, then again gave a reaction. Here, entries of all traders were taken. Many bought here, many bought again on the support reaction. Many traders accumulated here who were buying above the trend line. Then the market dumped and took out everyone's SL. Now, after SL hunting, the big players will take the market to here. Here, they will create a new inducement. Whose inducement? The traders who trade on the trendline breakout. They will keep their SL above this high and keep TP take profit. Now the market will give them a reaction too. Why will it give them a reaction? Those traders whose SL was here will enter here again, thinking now the market has broken out of the trend line. Now the market has to go down. It gave a reaction here. Another inducement was created here. Two traders got introduced here. First traders whose SL was taken out before, and second traders who trade on the direct breakout retest. What will the market do? The market will take out their SL as well and will give its big institutional move. Now, why won't this buying happen? What has come into traders? Fear of failure, FOF. They have had one SL hit, then another SL hit. Now they won't enter this buying. Why? Because they now have fear of failure, that they will fail again. This is how inducement works. Your SL gets twice, and then institutions make their big move. SNR inducement, support and resistance inducement. This was our market. The market took a bump here. Again, the market took a bump from here. The market went up. When the market came here, again, near the support, the market was coming near the support. The market touched above the support, took a little bump, then touched again, then took a bump. It made 1, 2, 3, 4 green candles. By this point, all retailers had come into a buying position. They had received confirmation here. Here they had gotten all the information, bullish engulfing, Morningstar, etc. All retailers came into a buying position here. Some bought here, some bought here, some bought on this pullback, some bought on the high of the high, and some bought on the first touch of support here. Okay. This means that all retailers had come into a buying position here. What did the market do from here? The market crashed. The market in one go took everyone's SL, stop loss. What was this? This was inducement for us. It was a trick to induce people, traders played by big players in the market to hunt people's SL. Making money in the market is not that easy. Just buying at support, selling at resistance, and you will be a millionaire in 2 years? No. Here the mind is used. Here mind games are played. For example, see here. The market touched the support, then again gave a reaction, touched twice. The third time when the market came here, the market gave a reaction, 1 candles made a third green candle. Here, people felt FOMO, fear of missing out. Now a big move is coming. We are about to miss the move. Here, retailers quickly entered here, placed their TP, take profit, and SL. Then what happened? The market dumped, the market ate everyone's SL. Well, then the market gave its upside move. Retailers were correct too. They had to go, and now the market also went. But when did it go? After eating their SL, it went. Why? Because they are always on the wrong side. They are retailers. Resistance inducement. This is also similar to support inducement, but of course opposite to it. Here the market respected a resistance twice, then the market was going towards it. The market moving towards it, touched it, gave a reaction here, then again touched it. Here it shifted the market structure and created another red candle from here. It introduced all sellers here. Again in this, some sold here, some sold here, some sold here, some sold here, and some sold on the first touch. What did the market do? The market in one go hunted everyone's SL stop loss here, and all SLs were hunted here. This is resistance inducement. Let's look at an example of it now. This was a resistance zone. The market gave one touch, two touches. It gave good respect. Then touching it, the market gave a reaction, meaning it created inducement here at this level, that this is a very good level. There are a lot of sellers here. Institutions are sitting here. Everyone is sitting here who is selling from here. So you also sell from here. When the market came here again, many sellers, many retailers started selling here. When selling happened here, what happened? Their stop losses were hit. The market ate up all their stop losses, then again made its move, and see what kind of move it gave. If you were trading ICT Inner Circle Trader in its place, you would see a fair value gap here. You would take entry from the fair value gap and see how well it held and respected the fair value gap. You would take entry from here instead of retailers, take entry from this FVG and take out a good target or RR. This is such a good trade. I will teach you all these things later, and I will make you an ICT expert before letting you go. Leave the retailer mindset kindly, and you will have to shift to ICT on the charts. Pattern inducement. Inducement that forms in chart patterns is called chart pattern inducement. Here we have the market. Here the market made a double top, which in retail terminology we also call an M pattern. What is taught to retailers? That here on the neckline of the M, you should sell. Whenever a double top forms, you have to sell on the neckline. Here, many retailers will sell, place their stop loss for the double top, and set their TP take profit. What will the market do? The market will directly go up from here. Now the market has come alongside the double top. Their SL, stop loss, is hit. Now the market is alongside the double top, and those who will sell at resistance will be introduced. They will sell at resistance. Here, inducement happens again. Here, the market will do a bit of consolidation, spend a little time here, and introduce as many sellers as possible, attracting as many sellers as possible towards it, making it seem like the market is about to fall from here. The market is standing above the resistance. A double top is formed. Sell here. Here, retailers will feel FOMO, and again, what will they do? They will sell here. Yes, they will create their selling positions here on the market. When enough orders are in place for SL hunting, the market will boom. The market will hunt SLs, and there will be an order block or a FVG, fair value gap, here. The market will give an entry to smart money traders, ICT, Inner Circle Trader, and then will give its institutional move. The retailer's bias was correct. They also sold, and we also sold. But what was the difference in our entries? They sold early while we sold after the retailer's SLs were hunted. This is the difference between retailers and us. We created our position here while the retailers created theirs here. We got a good RRR, risk-reward ratio, and our trade went into profit. Similarly, the W pattern, channel chart pattern, inverted head and shoulders, and who knows what else, these chart patterns are all useless. These can never give you profit in the long run. They are only taught to you so your SL can be hunted. These trend lines, supports, all these are pointless things. If you want to improve just a little, come a little above the retailer level and shift to SMC, smart money concepts. If you have the mindset, you can learn a lot. If you want to take trading to the long run, if you want to quit your job, if you want to be consistent in trading, then not even SMC, but something beyond SMC is needed. You'll need to trade at the ICT level. ICT is the reality in the market, trust me. This was our double top, meaning it was the entry area for retailers. Let me expand it further. This was our entry. When the market came here, it gave a good reaction, making retailers quite happy initially. But as more and more retailers were introduced here, seeing the strong reaction, the market gathered as many retailers as possible at the double top in one place, making it appear that the market indeed going to go down. The double top worked, and everything happened. The market made 3 candles, and all the stop losses were wiped out. Now the market is running live, so certainly the market will fall down as it has eaten all the stop losses. The New York session just started, so today New York's bias is definitely going to be down. Then we come to the market structure. Inducement, this is a market structure we have. In the market, the first step is to look at BOS and CA Seach, which means recognizing the trend. This was the BOS in the market. We will mark it as BOS. A break of structure happened, and this was not higher high. I will keep marking higher highs and higher lows. This was one higher high that we had. This higher high had a break of structure, meaning we confirmed a higher low. This was our higher low, and this became our higher high. Then the market made a break of structure here. The market made its higher high. The market came down. Retailers are positioned here. They have a higher low. They started making entries here. In my SL, what was the inducement? This was our inducement. The real higher low that we have is here. This will be today's trend change, but the retailers thought this would break, which makes it difficult to break. They made their long entry here, and they were stopped out. Their stop loss was hit, and we didn't have a break of structure. The market went back into its uptrend. Here, the market made its break of structure, meaning we were still in an uptrend. A break of structure happened, meaning our higher low was confirmed. We got our next higher low here. The market made a higher high here. The market retraced. And during the retracement, it left an inducement here. The market filled that inducement, eating the stop losses of the retailers here. Those who survived here, then even after that, the market did not shift its structure. Meaning, if I show you here, if this low had broken, we would have had chutch, but the market still didn't chutch. The inducement only ate the retailer's stop loss. Then the market will continue in its uptrend. Then you will see we have this inducement here and another inducement here. Now, when the market comes back here, retailers will assume that this is a high low. They will assume this low will not break. They will treat this swing low as support and make their long position here. Those who fail here will trade again here. And what will the market do? The market will have an order block here, and the market will drop from here and then rise up. This is one example of market structure inducement. The market was in a downtrend, right? The market went up from here, but the market didn't even BOS. Now, I will explain how there is inducement here. Where did the market BOS? Here, the market did BOS. A break of structure happened here. Where did the next break of structure happen? The next BOS should have happened here, but it hasn't yet. What did people think? People thought this is a lower high and it will break, changing the trend. So what was this inducement that we had? This was our inducement. And where is the real high low? Here it is, because this made the BOS. This hasn't yet BOS'd. The BOS will happen here. This is our inducement. Look, it has been swept live in the market. Hopefully the market has swept the inducement from here, and the market will fall from here and continue its trend after making its BOS. Psychological inducement. But last and not least is psychological inducement. This is one of the most important inducements. I didn't learn this from any book. ICT did not teach it to me. It isn't a concept of SMC. I experienced this myself in the market and learned it. I will teach it to you today. So let's assume this was the market and this was the London high. We had the London high and we had the London low, and the market came down. From here, New York started. New York went up, swept London's high by 1, 2, or 3 pips, and then came down. Here, 3 types of traders were introduced. This is the inducement where the most traders are introduced. So how does it work? Who all were introduced here? First, there were retailers who sold from a resistance zone. They saw a resistance level here and made a sell position from it. After that, which traders were introduced here? Those who saw the break of this high as a fake out, and they also sold from here. Who was the third trader introduced here? The third trader was an SMC trader. This is also an SMC trap. What will they think? They'll think this is a liquidity sweep of London's high, and now the market go down, right? They'll use chutch, fair value gap, or whatever for entry. We'll cover this later in the playlist. They will consider this a liquidity sweep, although a proper liquidity sweep should be at least 10 pips, minimum, okay? They will consider this a liquidity sweep and make their selling position here. Here, 3 types of traders were introduced, and there is a lot of money in the market. What will the market do? The recent order block, right? This was our recent order block. This is the ICT order block, which we'll cover later in the playlist. The recent order block here will tap into the market. It will catch buyers from there and then break out, hitting everyone's stop loss. The market will sweep London's high well and then turn bearish, right? This order block is a bit advanced. You can understand it as order flow. You have read about order flow in SMC, right? So consider it order flow. The market will go up from that order flow, sweep well, and sweep everyone introduced here, including London high traders. After sweeping them, it will fall in New York. This was our psychological inducement, guys. One of the most important concepts is liquidity. If you don't understand liquidity, you don't understand anything. The market runs on it. There's a video above on liquidity. Please click on it, watch the video, subscribe to the channel, like my video, and share my content. Goodbye.